The myths and secrets about trusts in South Africa, the truths we were never told. The proven way to beat the banks, SARS and creditors with their own game legally. This webinar is for entrepreneurs, property investors and business owners. Hi everybody, it's Jacques Fouché, founder of Trust Focus, part of the IGrow group of companies, the leading trust and tax company in South Africa, where we teach and train entrepreneurs, property investors and business owners how to create, protect and grow their wealth so that they can become financially free and be able to leave a legacy for their family and loved ones. The opportunity trusts present for the informed business owner, entrepreneur and property investor is enormous. There are two sets of rules in creating and protecting wealth. There is a set of rules for the poor and middle class, and a very unique and distinct set of rules for the wealthy and the rich. You've got the opportunity to create, protect and grow your wealth, as well as play the game of business, life and success with a very separate but special set of rules. These are the rules that were written by the rich for the rich, and this is called trusts. By you simply choosing the right vehicle to create, protect and grow your wealth in, you can ensure that during your lifetime and on your death, your family and loved ones will be protected. Choosing the correct structure is one of the most important decisions you will ever make. You should also understand that doing nothing is also a choice that many entrepreneurs, investors and business owners wish they had not made when they find out that they are being sued and are faced with a cold hard reality that they could lose everything they have worked so hard for during their lifetimes. Knowing that you are protected and safeguarded against SARS, banks and creditors, and a multitude of other risks should provide you with security and peace of mind. But peace of mind should not be an option. It should be chosen outright for ourselves and our families. We owe it to ourselves that our blood, sweat and tears be protected. Remember, there is no greater wealth in this world than peace of mind. If you're like me, then family always comes first. And we do what we do to ensure stability, security and comfort for the people we care about. The great news is that trusts are there for the ordinary South African as well, and not just a select few rich people. In this webinar, you will learn how the rich are saving millions in taxation and how they protect their wealth legally with trusts, and more importantly, how you can do this too. You will learn that the rich don't own anything, but they control millions. Millions in property, assets, investments and businesses. You will discover how they become bulletproof against creditors and how they manage to work less, earn more, and pay the least in tax. Is it unfair? Well, it might be. In reality, it is an unfair advantage that has been kept from the normal man in the street for far too long. Remember, there is a saying that goes, "He who makes the gold keeps the gold." The truth will be revealed in this webinar. You will be able to decide with which set of rules you would like to play the game of money, wealth, and business with. You will discover the common misconceptions and outright myths about trust structures in South Africa. The goal of this webinar is also to give you a better fundamental understanding and an holistic overview of the incredible power and benefits that comes naturally with a correctly structured trust. Let's begin at the beginning. What is a trust and where did they originate? Did you know that the concept of a trust is over 900 years old and originates from English law? The legislature, courts and legal practitioners have been responsible for developing South African trust law and what we find today. And today I'm talking about specifically the inter vivos discretionary trust, a living trust. A trust is a separate legal entity, but not a legal persona or a juristic person. A trust is created by a contract called a trust deed, which is entered into by the parties called the founder, trustees, and the people who benefit called the beneficiaries. The trust deed is lodged with the master of the local high court, and every trust is given a registration number called an IT number. In layman's terms, a trust is just a contract between the founder and the trustees on how the trustees should be managing the assets of the trust for the benefit of the beneficiaries. Just like every contract is different, every trust deed will be different, and the real value of a trust deed lies how the wording is structured and how the clauses of the trust deed makes provision for its specific purpose. Whether it's to acquire property, hold and protect paid-up assets, or safeguard and protect the shares of a company, a trust is the perfect vehicle for this. Who are the 6 key parties to a trust? Number 1, the founder. Number 2, the trustees. Number 3, the independent trustee. Number 4, the replacement trustees. Number 5, the beneficiaries. Number 6, the alternative or replacement beneficiaries. Let's talk about the role and function of the founder. The founder is the person who creates the trust and makes the initial funds available to the trust, and is also known as the donor or the settler. The founder sets out the terms, purpose, and reason for the trust deed to be created. The founder must be majority of age to create a legal trust, 18 years or older. The trust deed must clearly stipulate that the founder should not have control over the trust or the trust's assets. You should be the founder of your trust. Contrary to popular belief, the same person can be the founder, the trustee, and the beneficiary of a trust. It's very important that the trust deed is correctly structured. If it is not structured correctly, you will lose vital tax benefits, asset protection, and estate duty benefits. In terms of Section 9 of the Transfer Duties Act, you as the founder can transfer properties back into your name from the trust and into the names of your children and grandchildren without paying any transfer duty. This enables you to effect these property transfers transfer duty free. The trustees. It's the trustees who is charged with the administration of the trust, and they are appointed in the trust deed. They are the decision makers and will decide if investment properties are bought or sold or refinanced. The trustees of a trust may only act on behalf of the trust once they have received the letters of authority issued by the Master of the High Court. Trustees should be majority of age, 18 years or older. The trustees must comply with the Trust Property Control Act in accordance with the trust deed. The trustees of the trust act jointly, and there must be consensus between them in terms of all decisions made. Choosing the right trustee is essential because the majority vote system will not suffice. Who will be the trustees? It's normally you and your spouse and a third, unrelated, impartial, objective third party called the independent trustee. How many trustees should a trust have? There should always be a minimum of 2 trustees, one of those being totally independent from the founder and beneficiaries. It's best practice to find a juristic person that can act as the independent trustee. This is normally a company with trust expertise and experience, like our trust company, Trust Focus. The juristic person will nominate a natural person to represent the juristic persona as a trustee, the independent trustee. What qualifications do the trustees need to act on behalf of the trust? They need no formal qualifications, but the trustees must be persons of integrity, someone that will act with care, diligence, and skill expected of a person who manages the affairs of another. Married couples must be cautious before just appointing their spouse as a trustee on the trust. All trustees need to give consent to decisions to be made on behalf of the trust. And a nice tip would be that the Board of Trustees are the parties controlling and administering the trust, and all trustees must collectively give consent to decisions made for the benefit of the beneficiaries. Remember, both trustees will be required to sign surety for investment properties acquired in a property investment trust. The independent trustee. To ensure total impartiality and independence in the trust, the Board of Trustees must appoint a third party, an independent trustee. This is an arm's length person who will ensure a clear distinction between control and enjoyment of the trust assets. By appointing a competent independent trustee, the trust can satisfy SARS and other creditors that there is indeed a clear separation between you personally and you acting as a trustee of the trust. When appointing the independent trustee, Make sure it's a company or a person that is knowledgeable about trust law, trust administration, and the taxation of trusts. Trust Focus Pty Limited has professional people like our in-house advocate and our in-house trust and tax accountants. They are the perfect party to act as an independent trustee. Our advocate acts as an independent trustee on behalf of our company Trust Focus clients' trusts. He is then appointed as part of the board of trustees. It's also very important to note that the independent trustee is not related to the beneficiaries. This means no family members or friends should act as an independent trustee on the trust. The independent trustee's role and function in the trust includes the following: annual trustee meetings, drawing up of signing of resolutions when making decisions as the Board of Trustees, trust advice and guidance, ensuring adequate distinction between control and enjoyment of trust assets to SARS and the Master of the High Court. If one of the trustees is a juristic person, the National Credit Act provisions will not apply and the trust will not have to comply with their requirements. The replacement trustees. The trustee should make the necessary provision for replacement trustees. These trustees will then step into the shoes of the trustees who have been originally nominated in the trust deed upon the event of their death, resignation, or sequestration. The whole purpose of a trust is to ensure that the trust assets, the property investments, or the property within the trust can live on in perpetuity, meaning forever, and be passed on to your spouse, children, and your loved ones without incurring any death taxes, capital gains tax, transfer costs, or any other form of taxation. Clear provision in the trust deed must be made for the replacement trustees. They will take over from the trustees who have originally been nominated in the trust deed upon the resignation, sequestration, or death of the current trustees. We recommend you think the replacement trustees through very thoroughly before you nominate them. They could be your children, but they need to have reached the majority age of 18 to legally be able to act on behalf of the trust. This is for you to decide. The trust is very flexible, and the trustees you nominate in the interim until your children become trustees of the trust doesn't have to be a beneficiary of the trust. This trustee would preferably be appointed as an interim trustee until such time your children reach a specific age to take over the trusteeship. The trustees of the trust will make that call. The beneficiaries. Any person can be a beneficiary of a trust. In most cases, the beneficiaries would be the persons you would normally nominate to benefit from your estate in your will. Only nominated beneficiaries can benefit from the income or capital generated within the trust. There is no limit to the number of beneficiaries you can appoint to a trust, so it's vital to ensure that you, your spouse, children, and other loved ones are nominated as beneficiaries in the trust deed. You can nominate other trusts, associations, and charities and foundations as beneficiaries. Your company or companies may also be beneficiaries, or even other trusts you have set up may be nominated as beneficiaries. Your minor children can and is certainly recommended to be beneficiaries of the trust. A very important benefit is that a trust will protect the interest of minors on the event of the death of the parent, and this ensures that benefits due to minors are not placed in the guardian's fund. Remember, minors under the age of 18 years old cannot benefit directly from an estate. If the assets are not held in a trust but in your own name, and on your death bequeathed to a minor child, the assets will be liquidated, sold, and paid over to the Guardian's Fund, which is like a money market fund administered by government. You want to avoid this situation at all costs. The Guardian's Fund grows at a nominal 2% interest per year, and the bequests made to your children will be dramatically eroded by inflation by the time they have access to the money in the Guardian's Fund. And this will only be when they reach the age of majority, 18 years or older. Always know that an inter vivos discretionary trust is a contract for the benefit of a third party, the beneficiary. In my opinion, the beneficiaries should almost always be discretionary beneficiaries, so that the beneficiaries never have a vested right to income or capital within the trust. The final say must always remain with the trustees of the trust. to exercise their judgment whether a beneficiary should get income or capital from the trust, and if any. The beneficiaries will have no rights to claim any capital or income from the trust because they only hold a discretionary right to income or capital and not a vested right. Alternative or replacement beneficiaries. You need to give careful consideration to whom you will nominate as replacement or alternative beneficiaries. You need to know what should happen if, in the very unfortunate event, all the beneficiaries die simultaneously. If all the beneficiaries are dead and there are no beneficiaries that are nominated as follow-up or replacement beneficiaries, there will be no one to inherit your wealth, whether it's properties, shares, furniture, or any other assets that belongs to the trust. If this is the case, all your assets, blood, sweat and tear money, will go to the government. Always make sure that replacement beneficiaries are listed in the trust deed or specified in your last will and testament. Many investors and entrepreneurs ask me, what is a sham trust? Let me explain. A trust can be considered a sham trust by SARS and the courts if any individual party to the trust exercise too much control over the trust assets. This lack of independence can result in the corporate veil of the trust being pierced and penetrated. If the trust is not properly administered and does not have a bank account, it can be considered an extension of yourself and cause the trust to be deemed invalid. If no proper minutes of meetings and up-to-date resolutions and record keeping is done, the courts and SARS can also consider your trust or a trust to be a sham trust. This is where the independent trustee will play his part to ensure proper independence and that proper administration duties are formally documented and adhered to. Now let's look at the 7 biggest myths that surrounds trusts in South Africa. Myth number 1. Trusts are only for the wealthy. The truth is, the wealthy have set up these incredible vehicles called trusts for themselves and their loved ones and their businesses before they became wealthy. Trusts are there for ambitious, hard-working, visionary entrepreneurs and property investors that believe in their own ability to create and protect wealth the right and legal way so that they can enjoy the same tax advantages and asset protection advantages of the wealthy. The irony is that a correctly structured property investment trust, business trust, or family trust is the exact vehicle that has been used for over 900 years to create wealth and leave legacies with. The vehicle you choose to create and protect your wealth in is indispensable for you achieving your financial freedom goals. By using trusts correctly, you can benefit by saving literally millions in taxation over your lifetime, which could be used to acquire alternative assets like property, shares, or other investments. Myth number 2. Trusts have the worst tax rate. This is true, but only half the truth. It's only where the trustees decide to retain the profits and not distribute such profits to the beneficiaries where the trust will be taxed at the 40% marginal tax rate. Trust law and the Income Tax Act allows a trust, in terms of a concept called the conduit pipeline principle, to shift the tax burden from a trust to a beneficiary and therefore paying tax at the individual's marginal tax rate, which could be between 0 and 40%. You can be legally making use of this incredible mechanism to achieve much better tax efficiency than what you would have gained in your personal capacity. If your children are minors and not earning any income, it might be a smart decision to distribute the first 70,700 Rand of the trust's taxable income to your minor children. The first 70,700 Rand per taxpayer is free of tax. If you have 3 children, you will have this tax benefit times the amount of children you have. If you have 3 minor children, this could mean that the first 212,100 Rand would be free of tax. Myth number 3. Trusts are expensive to manage, maintain, and to administer. This just simply is not true. Trusts are not expensive, and in my opinion, one of the biggest misconceptions out there. The question you should rather be asking is, how much money is it going to cost me and my family by not having a proper trust created? In practice, a correctly structured and administered trust is a lot more economical and cost efficient than running a CC or even a company, a Pty Limited. What really is the most expensive is the cost of not having a proper wealth creation trust and wealth protection trust set up and created while you're alive. The costs of estate duty, capital gains tax, executors' fees, and income taxes that are not taken advantage of because you never took the time to set up or to create a trust is, in my opinion, very, very expensive. The bad news is you are going to die, and taxes will have to be paid and debts will have to be settled, but not in a correctly created trust structure, as you will see shortly. Most trusts, if specified in the trust deed, does not require trust to be audited annually, which will also save you a lot of money from an administration cost perspective. Myth number 4. I will lose control over my assets if it's not owned by a trust. There is a big difference how this notion of giving up control over your assets is executed in practice versus how it's theoretically taught and interpreted in our academic society. It is very important to note that there should always be a minimum of 2 trustees, one of those being totally independent from the founder and the beneficiaries. There must be a clear distinction between control and enjoyment of the trust's assets, and the unbiased, unrelated, and impartial third party called the independent trustee is the perfect person or juristic entity to satisfy SARS that there is indeed a clear distinction between control and enjoyment of the trust's assets. In practice, the trustees are the parties that control the trust. They are like the directors of a company. That's why careful consideration should be taken whether a spouse needs to be part of the board of trustees. With a very high rate of divorce in South Africa, the reality is almost a 50% probability that your spouse could become your biggest creditor. Ouch. There are ways of structuring your trust so that you don't feel that you're giving up control over your assets, and there are ways of structuring your trust where you will be the founder, trustee, and the beneficiary of the trust and still satisfy SARS and the master of the High Court of the legitimacy and lawfulness of your trust structure. If the concept of a trust have worked successfully for over 900 years, I'm almost dead certain that it can and will work successfully for you and your family members as well. Myth number 5. Trusts are being investigated by SARS. Most of our parliamentarians, politicians, and friends from our government have trust structures in place, and it would be very surprising to see them changing trust law so that they can lose millions of rands in their wealth portfolios because their wealth is also structured in a trust. SARS have been investigating trust for many years, but so is every other entity like a company, CC, and private individuals are investigated every year. Trusts are only being investigated when they have been brutally misused and mismanaged. If a trust is structured correctly and administered properly, according to the trust deed, trust law, and the Trust Property Control Act that governs trust in South Africa, you will have peace of mind when you sleep at night. Remember, it is the real wealthy that controls our government. The truth is, the real wealthy corporations and individuals all have their assets structured in multiple different trusts. Government will think twice before changing trust and tax law and shooting themselves in the foot. Myth number 6. Trusts are complicated and difficult to administer. In practice, trusts are a very simplistic vehicle. You normally have 2 qualified and competent parties to assist you, guide you, and advise you on how you should be administering and managing your trust. The first party is your independent trustee. He is there to take care of most of the administration of the trust. The second party is your trust and tax accountant. He is there to ensure that the financial bookkeeping is always up to date and to ensure that all transactions within the trust is legit and lawfully reflecting in the annual financial statements of the trust. Myth number 7. A trust pays transfer duty on a sliding scale, and it's exactly the same for natural people. On the value from 600,000 Rand to R1,000,000, transfer duty of 3% is levied on the value above 600,000 Rand. And on the value from 1,000,000 Rand to 1.5 million Rand, transfer duty of 12,000 Rand plus 5% on the value above 1,000,000 Rand is payable. And on the value exceeding 1.5 million Rand, transfer duty of 37,000 Rand plus 8% on the value above 1.5 million Rand is payable over to our receiver of revenue. Here are my 10 indispensable reasons why you must set up your trust before you do anything else, especially if you are an entrepreneur, property investor, or business owner. The first reason why trust is indispensable and why you must seriously consider creating this trust is number one, asset protection. Without any doubt, the best and most holistic asset protection strategy for any entrepreneur is to have a minimum of 2 trust structures consisting out of the following. The first trust is a family trust, the Wealth Protection Trust. We want to effectively separate assets from our liabilities in separate trust compartments or structures. This is referred to as a no-risk trust. Your wealth protection trust will hold debt-free and risk-free assets like paid-off cars, furniture, household contents, typically your movable assets, investments, listed shares in a share portfolio, and unit trusts, equipment, cash, and even your life insurance. And by the way, very few financial advisors know this, but there are substantial tax advantages and protection advantages if your trust owns your life policy and is correctly structured in your family trust, your wealth protection trust. If you want more advice on how to optimally structure your life insurance policy for protection and tax benefits, and how to move over or transfer all your personal paid up assets to your wealth protection trust, your family trust, you can contact our office on 021 979 2501. And for more information about what our financial and wealth planners and trust and tax accountants, that's all part of the IGrow group, are offering our investors currently, which I'm sure they can offer you the same service and advice. The second trust is your wealth creation trust, property trust, or business share trust. This is the trust where the money is made. This can be in the form of a property or business share trust where you will buy your buy to let properties in, and or where your business shareholding is protected in the business shareholding trust. Remember that having all your assets in the same trust can potentially cause the proverbial domino effect. This is where one asset is attacked and at risk and exposed to the same entity that house all your other assets. If this is the case, you stand the chance to lose all your other assets contained in that entity. Remember, one single asset being at risk can expose all the other assets contained in that same entity also being at risk. This is the core reason you don't ever want to mix your indebted assets with your paid up assets in the same entity. For the record and for asset and tax reasons, an inter vivos discretionary trust is the perfect entity to purchase and acquire your buy to rent property portfolio in. The second reason why a trust is indispensable is because there is no estate duty payable on death. One of the biggest tax bills besides your personal income tax bill you will ever incur occurs on your death. This is called estate duty. As much as 1/3 and more of all your life's assets, your blood, sweat and tears, will go to SARS on your death. The worst of all is that these are assets that you've acquired with money you already pay tax on. If your assets and properties are acquired in a trust, it will bring about a tax saving of 20% in the form of death taxes. This is, of course, over and above the 3.5 million rand abatement amount. Effectively, estate duty is a tax on after-tax assets, and this is what I call double taxation, and is absolutely insane and could be avoided completely by having a trust created. The most important thing that you have to remember is that a trust lives in perpetuity forever and that the trust will never die. It can literally live for multiple generations to come on the condition that the trusts is structured correctly. The third reason why a trust is indispensable is because there is no capital gains tax payable at your death. Capital gains tax is levied on the event of the disposal of an asset. The death of an individual is deemed such an event. On your death, it is seen as you have disposed of your assets to your deceased estate, and this triggers the tax on all assets. By having your properties and all your assets in a trust, there will be no capital gains tax of 13.32% payable. This means zero capital gains tax on your death and massive tax savings for your family and beneficiaries. The fourth reason why trust is indispensable is because on your death there is no executor's fees payable of 3.5% plus VAT on the gross value of your estate. If all your assets are in trust, you will have no estate to wind up and therefore no executor's fees applicable. Warning: if one of the banks or insurance companies are currently appointed as your executor in your last will and testament, it's important to know that your executor will be taking his cut of 3.5% plus VAT on the gross value of your estate. This converted to a percentage, the final cut is what I call it, the executor levies on your gross estate on your death, and this in and of itself is a frightening proposition and could be more than 10% of your net estate at the end of this whole exercise. By simply creating a trust and moving your assets over to a trust, your executor becomes nullified and irrelevant and loses his job and pay he would have received on your death. That paycheck can now go to your family instead of the executor. The fifth reason why trust is indispensable is that there will be no costs on death payable. Many costs will arise on your death, like costs to cancel bonds, costs to transfer any properties, as the estate cannot be wound up if there is any debt in the estate. If your properties are held in trust, the debt will not have to be settled and there will be no cancellation of bond costs as well as any transfer costs, as the beneficiaries can become follow-up trustees to manage and administer the trust and the trust's assets. The sixth reason why trust is indispensable is that it affords you incredible income tax flexibility, tax benefits and tax efficiency. Please remember that the primary reason why we create trusts is for asset protection. However, there is a very important concept called the conduit principle. The trustees of the trust can choose to let the trust pay income tax on its income, or they can choose for the individual beneficiaries to pay income tax in their personal marginal tax rates. If your children are beneficiaries and not paying tax on the higher marginal tax rate, it would make sense for them to pay the income tax rather than have the trust pay it, wouldn't it? The first 70,700 Rand income received for individuals earning income in South Africa is tax-free. So, if you have children that are minors, it will be a good idea to declare the tax liability of the trust income in their personal hands instead of the trust's. This means the tax liability of the trust can be dramatically and drastically minimized and cash flow optimized. You can do the same with rental income from your buy-to-let property portfolio, or even interest income that the trust generates through the money you have in the money market. This is an absolutely wonderful tax-efficient mechanism that are utilized and only available through the vehicle called trusts. The seventh reason why trust is indispensable is that minors will be protected. The South African law does not allow for minors to inherit. This is because they do not have contractual capacity. If you want to bequeath or leave your assets to your minors, your children under the age of 18, the assets will have to be liquidated and paid over to the Guardians Fund, which is like a money market fund administered by government. You definitely don't want the government looking after your children's money until they reach the age of majority, 18 years or older. Take care of your children and show your responsibility and love by creating a family trust to protect your wealth, not just today or on your death, but also for future generations to come. The eighth reason why a trust is indispensable is that there is no estate freezing, and your loved ones, like your spouse and your children, have access to your bank accounts, assets, and cash immediately upon your death. When you have your assets in a trust and one of the trustees die, it will have no impact on the trust bank account or cash flow. The trustee might have passed on, but the trust will live forever. The ninth reason why a trust is indispensable is because it is perfect for buy-to-let property investments. Unlimited losses can accumulate in the trust, and refinancing is tax-free. That can be used to accumulate more losses and purchase more properties with more tax-free money. If you truly understand the bigger picture about this scenario and the practically implementing it, it will be a total game changer for you and your property investment portfolio. IGrow Wealth Investments provides property investors with the most comprehensive strategy and advice on how to structure and build investors' property investment portfolios. Article 13 sex tax incentives added to your property portfolio will reduce the trust tax liability and increase your property portfolio's net return on investment dramatically. Article 13.6 is a tax incentive given to property investors by SARS, and this is the hottest tax incentive alive for the buy-to-let property investor. If you want more information regarding how to structure Article 13.6 tax incentives in your residential property portfolio, feel free to contact any one of iGrow's property investment strategists or trust and tax accountants at www.igrow.co.za, or just phone us on 021 979 2501 Cape Town, Durbanville. Number 10. The 10th reason why trust is indispensable is because you can leave a legacy. If your trust is properly structured and drafted, there will be comprehensive continuity and succession planning for generations to come, and assets will be transferred tax-free from the one generation to the other. The 11th reason why trust, in my opinion, is just indispensable is because a trust can be a self-sustaining and self-sufficient entity within a few short years. This means that the trust could look after itself based on sound progressive financial statements. The trust can also put you in a position in a few years from today to allow you the luxury to do away with and waive any sureties that the trustees had to sign on behalf of the trust. And it will allow the trust to qualify for its own properties and bonds or assets without you, the trustee, standing personal surety for the trust in your private capacity. This means a lot more properties and assets can be purchased and qualified for, which allows you to expedite and expand your wealth creation ambitions and objectives much faster than in any other vehicle possible. Number 12. You will become unsequestratable. Once you have created your wealth protection and wealth creation trusts and successfully transferred your personal paid-up assets over to your trusts, you will own nothing. Let me tell you a little secret. You will then also be worth nothing for liquidators and creditors, because if you don't own any of your own assets, there will be nothing that they can sue you for or take from you. You effectively become unsequestratable and worthless to creditors, whilst your trusts control millions. Let's dive into why it's important for your business share trust to own the shareholding in your business rather than you. Most people have a clause in their will, last testament, that establishes a trust on their death. This is called a testamentary trust, to look after their assets and wealth after they have died. A testamentary trust is the opposite to the inter vivos discretionary trust, which is a Latin term that means a trust created while you're alive. And this is the trust that we recommend at our property investment seminars. Our investors create for their businesses, property portfolios, and of course their other assets they own. Here are 11 things that will happen on your death when you own the shareholding of your company in your own name, and if it's not held in a correctly structured business shareholding trust. Number 1, the government values the business on the day of your death. Number 2, The business cannot operate for a period of time because the bank freezes the business bank account. Number 3, SARS does a full investigation in respect of your business looking for any taxes and VAT outstanding. Number 4, the executor gets appointed as long as 4 to 8 weeks later. The truth is nothing can unfortunately happen without his participation. Number 5, all the assets are calculated and added up and the liabilities are deducted at the day of your death. Reason number 6, your estate becomes liable for capital gains tax on the value of your business at the date of your death. This amounts to in the region of 13.3% of the net value. Now here is the catch. This taxation called capital gains tax must be paid in cash. If there aren't any cash or liquidity in your business account, your business and personal assets will have to be sold. Number 7, your estate will be liable to pay 20% estate duty. This amounts to everything above 3.5 million rand abatement that is allowed for individuals. Again, this must be paid in cash. And if you don't have access to cash, the assets will be sold on auction for far less than their true value, just to create the liquidity to pay SARS and other creditors. Number 8, don't forget about the executor. The executor fees are paid at 3.5% plus VAT on the gross value of your estate. Number 9, every surety you have signed for must be paid. Number 10, all the company taxes outstanding, VAT, pay-as-you-earn, STL, UIF, and income tax must be paid, and any penalties that are imposed must be paid immediately. Number 11, what is left at the end of this exhaustive and comprehensive exercise is given to your beneficiaries or transferred to your testamentary trust. My question again is, why do you have to wait to die before your assets is transferred over to a testamentary trust? The solution should be obvious, and this is to create a living trust, an inter vivos discretionary trust, a trust for your assets, property, and wealth while you're alive today. So start transferring your assets immediately so you can save possibly millions in taxation and adversity over your lifetime. So in short and sweet, when you own your business through a correctly structured business share trust, then this is what happens on your death. None of the 11 points mentioned above. Please remember the sole exclusive vehicle available to business owners to protect their Pty Limited's, their shareholding in, is a business share trust. No other legal structure will afford you the benefits and peace of mind as just mentioned. Here are 5 everyday risks that entrepreneurs, property investors, business owners, and wealth creators come face to face with daily during their business operations. Number 1, divorce. Your spouse could potentially become your biggest creditor. 50% of South African marriages unfortunately end up in divorce. Number 2, business creditors, suing you for loans or any amounts outstanding. Number 3, SARS is a massive financial risk that entrepreneurs, property investors, business owners, and wealth creators face in the form of estate duty, capital gains tax, income tax, and sureties. If your assets, your blood, sweat, and tears are not structured correctly in wealth protection and wealth creation trust structures, SARS will wipe out close to 35% of your net wealth through taxes on death. Number 4, business failure. In the event of your business failing, all your assets that are owned in your own name will be exposed to the first wave of creditors that will take judgment as fast as they can so that they can attach your assets and auction them off for immediate cash. Most of the time, your assets will at maximum reach 20% of their true market value. On the other hand, if your assets are structured in a trust and the trust is the legal and legitimate owner of your assets, you will be worthless to any creditor. Then no assets can be lost or attached because you won't own them anymore, but the trust will. Number 5, claims by employees. Your employee or employees can sue you for unfair labor practice. Your tenant can sue you for slipping in his property while showering. In an event like this, you don't want to own your assets in your own name. Weird things do happen. Here are 5 critical fundamentals to trust that is a must-do and will keep SARS and the courts at bay. Number 1, the trust must have a bank account. The Trust Property Control Act stipulates that the trustees must open a bank account. Also, know that the banks will insist on FICA documentation for every trust, like your proof of address, etc. Number 2, the trustees must register the trust for income tax. This is a requirement by SARS. Number 3, the trustees must always act in accordance with the Income Tax Act and the Trust Property Control Act. The trustees must ensure the following: that proper books of account are kept and maintained. The annual financial tax returns must be submitted to SARS, and it's critical to obtain the services of a trust accountant that is fully knowledgeable and specializes in trust bookkeeping and accounting. IGrow Wealth Accountants Pty Limited are the first choice specialist accountancy firm for thousands of trustees in South Africa to take care of their trust accountancy needs as well as their general income tax requirements. Number 4, proper trust administration is absolutely key. This again is the core function of your independent trustee. He is responsible with the trustees to ensure all trust administration, including all decisions made by the trustees, resolutions and minutes of meetings, are drawn up and signed timeously by the trustees. Number 5, when buying a movable property, the necessary resolutions must be drawn up to avoid any third party in attempting to resolve from the offer to purchase. All properly structured trusts are exempt from the National Credit Act insofar as the financing of immovable property transactions is concerned. In closing, plan and implement and take decisive action. Create the correct trust structures as soon as possible. The longer you wait, the higher your risk becomes to lose all your blood, sweat and tears that you've worked so hard for. The longer you wait to transfer your assets to the correct structures, the more expensive it becomes every year you delay this critical process. And the more you delay, the more tax you will pay that you could have saved and created wealth with. I really hope that what I've shared with you have shed some light on the myths, the advantages, and incredible opportunities that lie waiting for the entrepreneur, business owner, and property investor. Wealth protection and wealth creation is both critically important in today's society and volatile economy. With more than 80% of business owners who close their doors after 18 months after opening them, it's a real and frightening statistic. If you're serious about creating, protecting and growing your wealth, and very importantly, leaving a legacy, don't wait another minute. You can also attend one of our life-changing live property investment seminars by going to www.igrow.co.za. It's IGrow.co.za and book your seat online for our upcoming property investment events. You can also attend one of our life-changing live property investment seminars by going to www.igrow.co.za and book your seat online for our upcoming event in a province near you. You can also become a platinum member of the IGrow Property Investors Club to ensure you get the most tax-efficient savings when you set up your wealth protection and wealth creation trust structures. You and your family deserve to create, protect, and grow your wealth and leave a legacy for generations to come. Thank you very much for listening. Successful investing.